To order. Good morning. This is the Bloomfield Township Retired Employees Healthcare Benefits Trust quarterly meeting here at Bloomfield Township Hall. Let's rise to the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Item 2 is attendance. I note that all trustees are present. We'll move on to approving the minutes of the January 24th, 2024. Oh, I'm sorry. Thank you, Chris. I skipped number 3, public comment. Is there anybody here who would like to provide public comment? You have 3 minutes to address the board. Seeing none, we'll close public comment and move on. Now we're on number 4, approve minutes of the January 24th, 2024 Joint Board of Trustees, Financial Sustainability Committee, and Retired Employee Healthcare Benefits Trust meeting. They were in the packet. Any comments or questions? If not, then I'd look for a motion.
So moved.
Motion to approve by Trustee Kolinsky.
Second.
Second by Trustee Tice. All in favor?
Aye.
All opposed? Okay, that passes unanimously. We now move on to number 5, our quarterly portfolio review, and I welcome Brian Green from Mariner to address that.
Great. So when I think about the first quarter, before we get into overall results, I would tell you that the common theme in terms of what drove outperformance or drove underperformance on a manager by manager basis was legitimately down to like 1 or 2 stocks in each portfolio. Did you own Apple or not? Did you own Novo Nordisk or not? Just as those names, obviously, largest holdings. And I'll add a third one, NVIDIA. Because of the sizing of those positions in their respective indexes, right? NVIDIA and Apple being in the S&P 500. And Novo Nordisk being the largest stock in the international index, the ownership of those names or the non-ownership of those names was the primary driver of outperformance and underperformance for a number of different strategies. So if we take you in, to the book, you'll notice, new cover, new name change, new color scheme, as I'd mentioned, less green and more blue, and that does in fact hold true in terms of the change from a market commentary standpoint. If we think about the first quarter, it was markets continuing to find ways to grind higher and higher and higher. The S&P for the quarter was up 10.5%, which is a pretty solid start to the calendar year. Mid-cap and small-cap stocks up between 5 and 8%. International markets were in positive territory. I will tell you the story was, I think despite probably everyone, I can say 99.9% of the population wanting rates to decline, they didn't. While the Fed took no action in the first quarter in terms of any changes from a Fed funds rate standpoint, the fixed income markets continue to grind higher and higher, and we saw the 10-year Treasury go from 4% up to as high as 4.7. It's come down a little bit, but pretty significant move upwards. And particularly with the news yesterday, with the Fed pausing and saying we're not making any changes, and actually turning to kind of some more hawkish comments and kind of dialing back on some of their balance sheet activity as they're still in tightening mode. Still trying to slow economic growth, still trying to get inflation back under control. So I think for those that thought calendar year 24 was going to be a year of 3 to 4 rate cuts, if you go back to November, it was 4. If you go to December, it was 3. Today, the expectation is 1. And I would say it's a 50-50 proposition of a call for 1 cut, if not 0. So higher for longer continues to be the story. Despite that, at least in the first quarter, the equity market shrugged it off. We are off. The S&P is off about 6% in April. So you have seen markets trade off a little bit, particularly in the last week or so on the news of higher for longer. If I take you in to the book to page 3, which talk about overall results. So I will say the change you're going to see from this quarter to next is this book's going to get a lot shorter, just in terms of the number of pages. Because in April, we worked with Fifth Third, with Michael, with Jason, to consolidate the Retiree Healthcare Trust from an investment standpoint. And I want to make that important clarification. We still account for them and track them for their individual values on a monthly basis, but for investment purposes, they've been consolidated because it just gives us bigger and better opportunities. And I'll tell you the first Key example of that is last year we added Reinhardt to the DB portfolio as a small cap manager. In April, we added Reinhardt to the retiree healthcare portfolio as a small cap manager. And because of the consolidation, we were able to do that in a separately managed account instead of a mutual fund. That lower cost saves retiree healthcare trust about $5,000. So right out of the gate, first example of having that consolidation and the economies of scale helps drive costs lower. So for the quarter, overall retiree healthcare trust was up 3.65%. Lagged the policy index that was up 4.3. On a fiscal year basis, 12.4% return. It did lag the policy index that was up just shy of 14%, but still nice to see a double-digit return for the fiscal year. If we talk about for the quarter on an individual manager by manager basis, there's a lot of lagging from a number of different strategies. Again, as I mentioned, because of one or two stocks in each portfolio. Ancora up 6 and change versus their benchmark. They underperformed because they own Apple, and Apple is not a weighting in the large cap value benchmark. Edgewood outperformed because they didn't own Apple, despite it being a significant weighting in the benchmark, and because of their exposure to NVIDIA. Clarkston underperformed by about 2.5% for the quarter, 2.7%. Primary driver of their underperformance was actually one of their largest holdings, a stock called Clarivate. It's a spin out from Thomson Reuters that's a US and UK based data analytics company. As they've worked through kind of restructuring that business, I think that's more of a turnaround play. So early into it, and that stock traded off for the quarter. Oakmark underperformed by about 5.5% for the quarter because of one name, Novo Nordisk. It's amazing how these GLP-1 drugs are, Sara Lee traded off because people aren't going to buy, confections anymore and things like that. No surprises from Fidelity International Index Fund, single biggest driver of performance there, Novo Nordisk. JP Morgan in their emerging markets portfolio, actually slight outperformance for the quarter because of their growth bias and because of some exposure to a couple of banks in India. And then finally, from a fixed income standpoint on page 4, positive news out of Baird, being short duration, shorter interest rate exposure versus the benchmark helped them. Brandywine, because of longer duration exposure, they actually own some long-term treasuries in that portfolio. That was the biggest driver for their underperformance. So I would say the interesting theme for the quarter has been 3 names on a manager by manager basis. Were the largest drivers of either outperformance or underperformance, and it comes down to Apple, NVIDIA, and Novo Nordisk as being the biggest drivers of outperformance or underperformance for the quarter. But all in all, positive news. Did see a little bit of lag, but still comfortable with where things are from a manager standpoint. The portfolio was rebalanced in April to better align with the long-term policy targets. We have more comments just talking about new investments, but I'll pause there and see if there's any questions.
Questions from the committee? Brian, you said you were comfortable from a manager standpoint. It seems like Clarkston has been continually underperforming, and we're holding the mutual fund here. This is not an SMA like we have in the pension
Correct.
plan.
Correct.
So now that we've consolidated, can we look at, if we're going to stick with them, can we look at moving to an SMA, or are we still not at that level allocation?
Yeah, I will ask. They have closed that SMA to new assets, but that's new assets. That's not we're an existing client that wants to add to it. So I will inquire into that. The other piece that I can pull together is we can look at some historical performance for Clarkston. They've gone through periods of underperformance like this before, many, many times. So it's not a new occurrence, but they have consistently rewarded patient investors. So let me pull together a couple of exhibits that I think will help just kind of show this has happened before,
Right.
and how long do I need to be patient to see the recovery and subsequent outperformance.
And what is the Russell 2500 index? That's the benchmark.
Yep, so that would be essentially a proxy for small mid-cap stocks. It's the F-150 to the Silverado of the S&P completion index. Right, those two would both be similar proxies. The difference between is the S&P completion index would actually own some large cap names. Tesla was in that S&P completion index until it finally had enough good earnings quarters to qualify for inclusion in the S&P 500.
And they did not do well last quarter, right?
No, they did not. I saw a Cybertruck yesterday, which is kind of cool.
Really?
On that note, Oakmark.
Yep.
I know we've gone back and forth, we've had them present here before, and again, you've talked about how Clarkson has rewarded us long-term, we look long-term, which again, when you look back at our long-term numbers, where it's the 5-year number, we're half a point off of our benchmark, and then since inception, we're 0.2% off the benchmark, so we're within close. Oakmark is not.
Yeah.
Our 5-year is 2% off, and then inception is almost 3% off. Eventually, I understand we have these ups and downs, but eventually, if you can't even meet the benchmark, it's easier for us to go to the benchmark and not have the swings. Wouldn't you agree?
Yeah, and I think Oakmark needs that deeper analysis. They're another, same reason we have the index fund from a small cap standpoint is the same reason we have the index fund from an international equity standpoint, and that's that we have them paired against a pretty concentrated strategy, and that's Oakmark. Usually I can take you to a later exhibit in the book, but because their performance in the last year has been so difficult, I can't even say, hey, look at the 10-year number, and the 10-year number is still outperforming the benchmark. Like, they're lagging in every measurable time period, really because of what's gone on in the last year. I think it warrants a deeper conversation.
Because again, it's not that we don't want to reward, and I understand we have these ebbs and flows and these swings. We get to a point where if we're missing out on 2 and 3% per year, it compounds, and then we just get so far behind, we're looking for that home run, but one home run necessarily doesn't make up for, in this case for us,
Having-
6, 7 years of underperforming.
Correct. I think that's worthy of a deeper conversation.
Okay. Anything else? Okay, Jason? Good? Okay, so that was the quarterly portfolio review. Let's move on to item 6, new investments. So as Brian said, it was a busy quarter for this, or actually we did it in this quarter rather. At the end of March 31st, we consolidated, so on April 1st, we consolidated all of the trading accounts for the different, subunits into one larger account. We rebalanced based on the new targets from the investment policy that was voted on in February. And we put in our annual contribution from the general fund into the to fund. I think it was 1.75, right?
1.8.
Combined with public safety.
For all of the OPEB,
Yep.
1.75 million, right? And so right now that was just sitting in cash at the end of the quarter, looking to find an allocation. And so one of the things that I wanted to do was recognizing that this fund in its life cycle is at the point where we're accumulating assets and growing it. We're not actually pulling money out of the trust to pay benefits to the retiree. We pay for the retiree's benefits out of our operating budget. So it's really in an early stage of the fund's life, and it'll probably exist for another 50 years. And so I thought that was a good opportunity to introduce some newer investments, some less liquid investments, and those would be in the real estate sector and the alternatives asset class. And so I asked Brian to prepare a book on opportunities in both real estate as well as private debt and private equity, to look at opportunities to add some good returns to the portfolio. So I'm going to turn it over to Brian to talk just a few minutes about what we looked at and what we're looking to do.
Great. So as Michael had mentioned, when we look at the cash flow projections for the trust, with no need to draw on the funds, there's the opportunity to take advantage of the opportunity to be compensated for giving up immediate access to your funds, right? If I don't need the money for 10 years, why do I need it to be liquid on a daily basis? So we had explored a number of opportunities. So everything that we presented is, is have a basis from our standpoint. We have a research team that's meeting with, thousands of managers a year. So we may present an opportunity to the township, and it might be, hey, we think this opportunity is worthy. And the example that I'll use is Marathon, a distressed debt manager that we're recommending be placed in the retiree healthcare trust, that recommendation is based on meetings with 100 other distressed debt managers. So it may be like, well, we only looked at one, and it's, well, we only looked at one because you have the luxury of our team looking at 99 others and understanding that as we've looked at all of those and done operational due diligence and, talked to other investors and prior investors, that's where we have the luxury, or have not the luxury, but the confidence of come to you and saying, we've explored the landscape and we think this is the best option for you. Similar vein, the recommendation to add an allocation to Bloomfield Capital. So Bloomfield Capital is actually a firm based in Birmingham that provides loans to real estate projects. But unlike, traditional banks, these are projects that are in some type of transition. So they provide essentially bridge loans. So it's, 18 to 36-month loans to individuals or developers purchasing properties, typically at SOFR plus 6 to 8%. So kind of low to mid-teen interest rates plus a couple of points. And you may ask, who would, in their right mind, would pay 14% interest, for a real estate loan when I can go to the bank and get it for 7%. And I know 2 years ago I could go to the bank and get it for 3 or 4. What it really comes down to is a couple of things. Number one, the banks aren't lending. So if I need money, it's a source of it. Number two, in many instances, the opportunities that they are being a part of don't fit the traditional bank lending model. And that could be speed, that could be occupancy, that could be, a need for improvement to the building. So they work with their borrowers, not only, I'll give you an example, recent loan on an apartment building was at 60% loan to value. And that value wasn't based on the appraisal that happened a year or 2 years ago. That was based on appraisal in today's market with today's interest rates, today's cap rates. So we'll loan you 60% loan to value based on today's lower value in a first lien position. And we're going to get personal guarantees from you, and we're also going to tag every asset that we can possibly tag from a personal standpoint. So we have the ability not only to foreclose on the property, but also have the ability to garnish your assets. And what it's done from a long-term standpoint, and it's about a 15-plus year track record, has been, even in a low interest rate environment, kind of high single-digit consistent returns. And in the current interest rate environment, it's low double-digit expected returns that are really paid quarterly because it's loans. And it's the opportunity, we think, to have exposure to real estate, but do it as a lender rather than an equity owner. And given the degree of uncertainty with, how long, how high for how long, what is the impact going to be from a commercial real estate standpoint, we think it's a great opportunity to diversify the assets in the retiree healthcare trust, have exposure to real estate, but do it in a pretty conservative way, and help continue to drive returns.
Yeah, I think, on the Bloomfield example, I think it's worth noting that we own in the pension plan, not in this plan, in the pension plan we own 2 real estate equity funds that buy and hold real estate. And again, they tend to do it, buy, improve, and sell is the TerraCap model. But that's still an equity position. You're behind the debt, and if something goes wrong in the deal, it's the debt that's going to get paid first. So to be able to have exposure to the real estate sector, do it as a lender with greater security, preservation of capital in mind, and still get a potential double-digit return with a quarterly cash dividend, I think is really attractive. The last thing I want Brian to address is we also talked about on the private equity side, capital dynamics.
Yep.
And so I wanted you to just give a couple minutes on that as well.
Yep. So, from that standpoint, again, to say you're investing in private equity is like saying you're going to purchase an automobile, right? That could be 50 different makes and models, thousands, right? There's thousands of different options. So for us, as we work with our research team and talking about building out, the recommendation that we made was to start investing in what's called a secondaries fund. So rather than investing in a portfolio of private equity funds that's putting new money to work, right? Every dollar that's invested is into a new opportunity going forward. A secondaries fund is actually a part of the market where the general partner that we're working with is going and purchasing existing private equity portfolios. And that could be, you know, think about some of the news with some of the big Ivy League universities that are divesting of part of their private equity portfolios because of a change in allocation, because of a change in leadership, or it's a general partner that needs to provide liquidity to an investor. So the beauty of allocating via the secondaries is we go back in time. So we get to invest in portfolios that started in 2015, 2016, 2017. So you have tremendous diversification from what's known as a vintage year standpoint, and you also get to kind of enjoy some immediate write-up in the portfolio, right? If I'm buying an existing portfolio that's at a discount to its current net asset value, there's kind of an inherent immediate return potential in that. The flip side of that is if we're buying it at a discount and markets get worse, there's a cushion there from a downside standpoint. So in looking at, you know, building out the new piece, we specifically recommended Capital Dynamics to the township. You know, in working with Michael, there were 4 different options that our research team had brought forth in addition, you know, after going through a number of meetings with other strategies. But Capital Dynamics we thought was the best fit because we expect probably 35 to 40% of the commitment to be called right away. So rather than slowly trickling in over the course of the next 3 years, we have the opportunity to have kind of an immediate allocation to private equity that will then start to grow. The expectation of the likelihood of an early markup in the portfolio, just given where they have things currently right now. And then tremendous amount of exposure because they do, you know, lower middle market buyout. They have a good chunk, about 40% of the portfolio in venture capital, which I would say this is probably a pretty good time to start entering that, given the amount of carnage that's happened in the tech industries in the past couple of years. So being able to purchase some of those legacy funds at a discount into some really good strategies we think will be a good driver of returns for the trust.
Okay, I just wanted to refresh the committee's memory. In our most recent investment policy statement that was approved by the Board of Trustees, we have an allocation of 10% into real estate, a 10% allocation into alternative investments, along with a 10% investment in fixed income, which we currently have in the Baird and the Brandywine, although we did exit from the Brandywine, and we're going to keep it in the Baird for the 10% allocation for fixed income, and then a 70% allocation, a target allocation for U.S. equities. So, does anyone have any questions for Brian about, as we look at these new asset classes, new investments?
Yeah, I just have one. You gave us kind of an idea of where we were expecting returns in some of those, especially with Bloomfield Capital. Where is the expected returns with the other one?
So, so for retiree healthcare, we're talking about Capital Dynamics and
Correct.
Bloomfield. For Capital Dynamics, it's kind of what you'd think of as a traditional long-term private equity, like it's exiting these portfolios over the coming, so Capital Dynamics goes out and purchases limited partnership interests in existing funds. Those funds then have an underlying portfolio of, say, 20 to 30 companies. So at the end of it, you know, we have a portfolio of probably 500 to 600 underlying individual companies that all are working through their business plan to be acquired, to go public, to be purchased by another private equity company. So kind of the harvest is as each of those underlying portfolio companies executes on their business plan and has an exit, that's capital that then is returned back to us. But it's it's kind of a 7 to 10 year. Bloomfield Capital is a kind of 4 to 5 year life from a round trip standpoint. From a private equity standpoint, it's more of kind of a 7 to 10 year life cycle. Maybe a little bit longer than that from the standpoint of, you could have 5 portfolio companies remaining that need another year or two, but the bulk of the return is expected in kind of the 7 to 10 year time frame.
Jason? No? Chris, anything else?
No, thank you.
Okay. Brian, thank you very much. I'll note that the next meeting is Thursday, August 1st, 2024 at 7:30 in the morning, again here at Township Hall. And unless there's something else, I'd look for a motion to adjourn.
So moved.
Second.
Okay, we have a motion and a second. On the motion to adjourn, all those in favor say aye.
Aye.
Aye. Opposed? And that passes 3-0. Thank you very much.